Good afternoon, everyone. This is Michael from T3 Live. Can I get a quick sound check? Can you type a 1? If you could hear me, just type a 1 in the box if you can hear me. Thank you, Ahmed, Al, Amar, Shane. Thank you, guys. Welcome to today's event, a new way to find options trades that offer higher rewards with clearly defined risk. We are going to wait a couple more minutes to get people in the room. In the meantime, please read our disclosures. So while you guys are reading this, why don't you type in where you're from? We got a pretty big crowd. We're just curious to where everybody's dialing in from. All right, let's see. New York, Bahrain, North Carolina, Los Angeles, California, Montclair, Toronto, Panama City, Netherlands. So we got a good international crowd. Colombia, Houston. Okay, here's the other disclosure, guys. Please read this. As you know, this event is for educational and entertainment purposes only. Nothing is to be construed as an investment advice. I think we're all adults. Everybody gets that. So we are very excited to be here. We haven't done an options webinar since Valentine's Day, so we are really excited to get started. But before we get going, and I introduce your hosts, the housekeeping items. Yes, we are recording this event. We will send you the recording. We are going to hold a Q&A. Please hold your questions. We will get to as many questions as we can. And big thing is we have an all new opportunity. And when I say all new, I mean all new, because we are announcing something completely new today that we have never offered before. And please turn off your trading platform, your smartphone, your TV. We have some very big things to talk about. We want to make sure your video is clear. We want to make sure your sound is clear. We want you to make sure you get everything. So please turn off any distractions. So first host is Dan Darrow. Are any of you guys on the VTF? Anyone from the VTF in here? All right, so many of you guys know Dan. He's a professional options and equity trader. He's been a professional trader for over 11 years. He specializes in event-driven option strategies, and that is going to be a big focus of what we talk about tonight. And Dan, basically, he's looking for stocks that move, stocks with major news catalysts. If you know anything about options, you need to find stocks that move if you want to make money. It's all about volatility. Co-host is Kurt Capra, who is a T3 Live trading strategist. He has 9 years of trading experience. Kurt is basically my personal technical analysis guru. When I need advice on charts, we were talking about the Russell 2000 today, I always go to Kurt, because Kurt is my guy when it comes to the charts. So with that said, we're going to get started. We have a lot to talk about, so I am going to pass the mic over to Kurt. Kurt, how are you doing today?
I am doing well. Can you guys hear me?
Yep, we can hear you. Just make sure you share your slides.
All right, awesome. Let's get this going. All right, so hopefully you can see my slides here now too.
Yep, all good.
You guys, perfect. Okay, cool. So let me get this drawing tool out. So you should also see the arrow for now. If I need to draw anything, I'll switch it over. And actually, let me do this instead. We'll do the spotlight. Anyway, all right, so we should be good to go. Appreciate you guys joining us here today. What we're gonna cover, 4 money-destroying mistakes that cost traders like you guys here money every single day. And you know, when I say it costs you guys money, whether you're trading options or not, it could be costing you money, right? If you're not trading options, it's costing you money because you're missing out on an opportunity. And if you are trading options and you find them either confusing or frustrating, or you know, you picked the right direction, but maybe the time frame or the option you chose was wrong, it's costing you money. So we're going to get into that, and we're also going to talk about one completely underrated area of options trading that most traders ignore completely. Okay. I see somebody saying no audio. Just, you guys can still hear me, right? I just want to make sure it's on their end, not mine. All right, cool. Perfect. Appreciate that. All right. So real quick, out of curiosity, how many of you guys are trading options now versus how many have no experience? Give me a 1 if you are trading options. Give me a 2 if you're not, but interested. All right, so I see plenty of Ones, twos, ones, twos. All right, cool. So pretty balanced out group, which is awesome. All right, so let's get into the 4 big mistakes. And so for those of you who are trading options, obviously I would expect that either you know these mistakes from either making them currently or having made them. And if you are new to trading options, these are going to get you ahead of the game so that hopefully you can avoid making these mistakes and preventing it from happening altogether. So mistake number 1, picking the wrong time frame. Choosing the wrong time frame or picking the wrong expiration for your trade is hurting your profitability. So you have to buy options contracts that maximize your risk reward. Your chosen strategy has to match the outline that you expect. And sometimes paying more money for the longer term options can actually help the profitability of your trade. Now, that may seem a little counterintuitive, but as we will discuss, and as I'm sure Dan will cover as well when we get into some of the trade examples that we've placed over this earnings season and prior, just to give you guys a flavor of what it is we look at and how we approach things. But sometimes you want to give yourself the gift of time, which may cost more, but there are times, no pun intended, where not picking the right time will cost you money. And that is, again, mistake number 1. All right. So you want to make sure that you're aligning the strategy to your expectation in a way that maximizes the risk reward parameters. So as an example, showing why the time frames matter. Let's pretend that we've gone back in time. It's July 10th. You think that IWM, the Russell 2000, can hit 170 plus. So, and you think that this can happen within a relatively short period of time, let's say, a month or so. So you pick up an August 24th 170 call for around $3. Now, as I'm sure you guys well know, the Russell hit over 171 here today. But those calls were trading around $1.50 this afternoon. So that's about a 50% loss. Obviously, there are better ways to make directional plays than just saying, okay, I think this is going higher, let me buy calls. That is the most basic approach you can use, but it's not necessarily the best, right? So choosing the wrong time frame or picking the wrong expiration is hurting your profitability, right? I think we already covered this one, actually. I think I went backwards by accident. So here's a chart of those contracts, those August 24th 170 calls. Again, even with today's huge rally, it's still down, right? Again, let me just pull up my spotlight here, right? You bought it for around $3 back on July 10th, right? That's where it was on July 10th. Then over time, it deteriorated, it lost value. And again, even with today's huge rally, it was still down about 50%. So just because you were right in direction, you were right in the expectation, doesn't necessarily translate to a profitable trade when it comes to options. So weekly options are extremely tempting because of their cheaper premiums. And this is mistake number 2. Overdosing on weekly options. These so-called cheap weekly options are nothing more than lottery tickets. And just like lottery tickets, these options are a tax on the poor. Once you understand options pricing basics, which we cover in our course, and we have got a special offer that Mike's going to get into later on that, but once you understand options pricing basics, you're going to understand why these options were quote unquote built to die. These options only make sense in very specific situations. So it's best to avoid them altogether for now until you become a more seasoned options trader, understanding these pricing structures and what you're really looking at before you want to start introducing these weekly options. As an example, I'm sure that you guys have been following gold, or at least have heard about the decline in gold. So let's say that after seeing gold decline, you said, you know what, it can't go down much more. So you call the bottom on GLD August 15th. You get in the 112 weekly calls expiring on August 17th. GLD rallied to close out the week at 112.13. So again, you were right. You nailed the direction. You called the bottom. But even with GLD's rally, the 112 closed the week at just 12 cents, which was down again almost 50% from the 8.15, the August 15th close. So bottom line, weekly options have their place, but 99% of the time, there are better tools to use. And more often than not, giving yourself the gift of time will often pay out. And again, we'll get more into the details of that as we go on and look at some of these trade examples as well. But again, you can see here the GLD August 17th, 112 calls. This is a 15-minute chart from August 15th to August 17th. And as you can see, it continued to lose value. And despite a valiant effort on the final day, it wasn't enough to change the outcome. It was still almost a 50% loss. But again, you were right in the direction. So if you find that you're right in the direction, but your options trades aren't translating to money in your pocket, this is going to be a solution for you, right? We're uncovering these mistakes, and that's half the battle, right? Understanding that you're doing something wrong is half the battle. And then the next thing is committing to something new or different, right? So that you can change the outcomes. So let's move on here to mistake number 3, treating trades as an all or nothing. It's not like equities where you're either long or short. It's all or nothing. Proper trade management can mean the difference between a winner and a loser. Too many traders think of trades as home runs or strikeouts. It doesn't have to be that way. A proper take profit strategy lets you pull money out of a trade and improve your risk reward. By rolling up or rolling down these contracts, it can improve your profitability by extending the life of the trade, more or less playing with the house money. If something's working, why exit? Why not use the money? Why not use the proceeds from the trade and roll those contracts up or down depending on the direction so that you can continue to profit from that position? So again, this doesn't have to be an all or nothing type of end game, if you will. Proper management is vital. Right? And that's just a universal concept. It doesn't matter what it is you're trading. If you don't know how to properly manage positions, whether they're in the money or not, sometimes you're managing a loss. Right? But the bottom line is if you don't have proper trade management, then you could really be doing yourself a disservice, whether that means you're leaving a tremendous amount of money on the table by not rolling up or down, or maybe there's some kind of event coming up that you're not aware of. You've got this options trade on, and maybe picking up a put or a call could help give you a little bit of extra coverage, if you will, or what's the word I'm looking for? A little extra safety in a sense. So anyway, it all comes back to proper trade management and understanding this isn't a zero-sum game. NVIDIA earnings we can use as an example. It dropped early Friday, but then rallied to crush the value of put options before then falling again. So a couple different scenarios here. You could have sold out for a loss at the open or consider your quote unquote options. Okay. The better choice would have been to have rolled out the put options to extend the life of the trade, right? If you thought that, you know what, despite the early rally, right, I still think NVIDIA is going lower. So you could have rolled out the put options to extend the life of the trade, or you could have scaled out and actually have a gain by the afternoon. So you need to have this flowing or rolling type of strategy where you're not just boxing yourself in. You're not saying, okay, well, if I think NVIDIA is going to drop, I'm going to pick up these put options and that's it. That's the end of the trade, or that's the end of the work that I've now had to do. Let's wait till expiration and see what happens. Right? That's not the mentality or the approach that you want to have. All right, mistake number 4, ignoring implied volatility and time decay. Now, this is where traders, when it comes to options, start getting lost. When you start talking about implied volatility, time decay, things like this, it starts to get a little more esoteric, and traders get, quite frankly, they get a little turned off. They think it's a little too confusing or complicated. That's not the case. If you don't understand implied volatility and time decay, you are literally handing money over to your competition, but it is not as confusing as most make it out to be. So you must know what kind of stock move an option is pricing in. And understanding the IV or implied volatility means knowing when you're getting a bargain and when you're overpaying. And again, Dan's going to go into some of these concepts, especially here now that earnings season's wrapping up. There have been some tremendous opportunities if you understand implied volatility, and not necessarily in the stock that's reporting. You know, sometimes what we've been able to do is take advantage of names that aren't reporting but within the same sector, because the IV, the implied volatility, is at a bargain. All right. So you need to understand that. And also the passage of time is the most powerful force in the options universe. It literally can make you money or cost you money. And we looked at some of those earlier examples. I mean, we looked at the Russell example. We looked at the gold example. Both of those lost money in part because of time. So if you're ignoring these two factors, these two forces, if you will, again, this is a huge mistake. And it may be the most deadly mistake of all, you know, because again, you'll have traders say, I bought call options, the stock went up and I still lost money. Why? They don't understand why this happened. They know the cost of an option, but not the actual value. So they're buying options which are so overvalued, it's nearly impossible to make money. It's almost as if they were destined to lose. And traders also ignore the impact of time on their options. Time will eat your positions alive unless, as we said, you understand it. Right? So these two concepts alone could help to start unlocking, quote unquote, unlimited potential profits. And finally, mistake number 5, ignoring the calendar. The calendar is full of trading opportunities as well as risks, but more often than not opportunities, right? They're risks if you don't know that these, you're making these mistakes that we've been covering. If you don't know how to take advantage of the mistakes that so many are making, then yes, it is a risk. But if you know these things, you will see all of this as opportunity. Options are priced based on upcoming catalysts. So if you don't know what you're paying for, it's going to cost you. Stocks have huge moves on events, and that means huge opportunities in options. Oftentimes, the market is confused when it comes to pricing these events, and you can take advantage of that confusion if you know what to be looking for. And this has played out perfectly. It's played out in spades here during this most recent earnings season. And again, Dan's going to get into the examples and show you, the kind of nuts and bolts of what was going on throughout the thought process and the options and why we chose those versus something else, etc. I'm covering the mistakes. Dan's going to cover the corrections, if you will, to these mistakes so that you can begin to take advantage of the mistakes that so many out there are making. So 5 reasons that we love event-driven options trading. And it all ties into the mistakes that we just covered. Number 1, rising market volatility means bigger dollar moves around events. Now, whether that be earnings, whether that be drug news, whatever the case may be, increase in volatility means bigger moves, more opportunity. And we can see those opportunities coming, right? When you know what the calendar looks like, when you know earnings are coming up, drug news, what have you, you can almost foresee where the opportunities are going to be. So with a busy calendar, right, there are things like, as I already said, earnings, economic data, central banks, etc. We don't need to always be right on the market direction. Sometimes you can just bet on volatility. You don't have to pick, I think this is going to go up, I think this is going to go down. All you need to know is, hey, there's some news coming up, whatever that will be, whatever that news is going to be. I know that there's going to be an increase in volatility, so let me just bet on that. Let me bet on movement. And that's another reason we love these event-driven options, is because you don't even have to pick a direction. You can just say, hey, I know this is going to move, and that movement can make me money. And finally, number 5, your competition is obsessed with the Turkish lira and China. Right? That's where all the focus is. That's where all the talk is. Trades are literally slipping right by them. And a lot of the obsession, if you will, is just banter at this point. A lot of these things are getting priced in. So literally trades are slipping right by them. All right. So our event-driven options trading philosophy, we're now going to get into the actual nuts and bolts, the trade examples. And for that, I'm going to hand it over to the real reason you guys are here, and that is Dan.
Can you guys hear me? Give me a thumbs up. Taking over here from Kurt. Cool. So yeah, glad to take over. Like Kurt said, I am going to take you on kind of like the tour of what he calls like the nuts and bolts of it's kind of like the earnings or event strategy. Like he said, again, like we went through the mistakes and now we kind of want to show what the corrections to those mistakes are. So, for all of you guys that are joining us from the VTF, it's nice to have you on, and for everybody else, if this is new to you, we're going to kind of walk through it. And, if you have any questions, definitely, please bring them up at the end. But we're going to try to go tackle it all at once. And then if something comes up, we'll try to get to it at the end when we have a Q&A section. Okay, cool. So when it comes to events, we like to say that the option strategy can be narrowed down to a few simple rules, basically. And we're going to expand on these ideas in the next couple slides and using the examples, but really at its core, these are what our thought process is when we approach an event and want to design an options trade for it. And the first rule is know what the market is pricing. And this one's pretty self-explanatory, but really you always want to have an idea what the market is expecting, right? And that, for an options trader, you'll probably hear it a lot, and that's what the priced in move is. So, that's the move that they're expecting. The implied move, you also hear it called, but it's just something that you always need to know. I mean, when events are coming up, you need to know what the market is pricing. Understand what the market is not pricing in. So, this is basically looking at the trade from just the opposite point of view. So, glass half full, glass half empty. And it might sound kind of strange, but you really want to look at what the market is not pricing in, right? So it's what type of news has transpired, or what type of technical development has transpired during their period that could kind of create a move that the market really isn't anticipating, right? So there's what's priced in, and then there's what's not priced in, and that kind of gray area that's not priced in is really kind of how you beat the street. So it's when you come to these events, I mean, this is really what we're focusing on, is what's not priced in. Compare expectations with similar events in the past. We want to know what the stock did on earnings recently. So 2, 3, 4 quarters ago, how the stock acted on those quarters. But also for other events besides earnings, we want to see how, for instance, how the banks acted on recent days when the Fed hiked rates, or what Apple did on its developer conference day last year. The history, the past history is kind of a guide for us. So we always like to know what a stock did on key events, key recent events. We don't want to go back 5, 10 years, but 1 year, maybe even 2 years. I mean, we always kind of want to have an idea of how that stock behaved. And then obviously we want to estimate our chance the market is wrong. I mean, that's how you plan your risk to reward scenario, right? So, some trades are going to have a lower probability of success, but a higher potential payout, while some are, maybe a higher chance of success, but also a lower potential payout. So you're trying to estimate the chance that the market is wrong for those options. And then identify the specific option strategy and contracts which fit the risk reward. So we're looking for what contracts provide that large reward potential, but we also want to find contracts that fit our really kind of well-defined risk parameter, right? And to us, that's kind of what makes our strategy different. It's we have a pretty well-defined guideline, and for those that follow me on the VTF, or for those that are already subscribers to the options of play letter, that we try to keep our risk really well-defined in kind of a narrow band, and that's definitely that's definitely, when we approach the trade, that definitely factors into the overall opinion of the strategy. And then last but not least, I mean, once you have that plan in place, you got to put it into action, and then it's go time, right? So there are definitely all sorts of different events. You know, we'll outline some different ones later, but the majority of our focus is definitely on earnings. And the inputs that we're looking at when we're scanning for earnings setups are basically an expansion on those rules that we just covered in the previous slide. So the first one is how the stock performed versus expectations after the last 3 earnings, right? So we talked about that. We like to go back and we like to see how the stock acted or responded to earnings, you know, last quarter and the quarter before that. But that also means, you know, we want to see how it traded, say, on a beat, you know. So like sometimes like a stock will sell off on a beat, or if it, you know, if it rallied on a beat, or if it rallied on a miss. So it's not just exactly what it did, but how it responded to what the numbers actually were, right? Implied volatility relative to historic levels. So the past performance helps us predict how the stock will react, but the implied volatility also kind of tells a story here. We want to know how big of a move the market is expecting, and how expensive the options are, and really how that compares to what it did in the past. So just for example, like a quick example, we'll get into more in the coming slides, but you know, just say like Amazon moved 5% the last 3 quarters, right? Then odds are the options will most likely be pricing in a 5% move for the upcoming earnings. But if they are more expensive than 5% or cheaper than 5%, we want to know why. Fundamentals and news that can trigger a bigger technical move. So what happened during the quarter? You know, was there any major development for the company or for the sector, like, you know, tariffs or oil rising or maybe a new drug launch, stuff like that? Unusual options activity. We don't like basing our trades on big blocks of options. I mean, if you followed us, you probably already know that, but we just don't know when you see like all the unusual option activity, we just don't really know what they are exactly targeting. I mean, it could be positioning, you know, for something that is, you know, completely against what like the option activity is indicating. So we like to know option activity, but only in the sense of if it's like repeated. So if we see consistent heavy positioning, you know, for a few weeks or a month before, you know, it's always worth keeping an eye on, and it could kind of, you know, help us get a bias or help us understand what the bias is of the smart money. So that's why we say unusual options activity, not just, you know, if you see like 500 calls bought, you know, right before earnings. I mean, like that doesn't help us as much. And then which strikes, expirations give us maximum reward to risk potential. So we want to know what option strategy makes the most sense. Calls, puts, straddles, strangles, but also, you know, is it shorter term contracts versus longer term? Is it going to play out fast, or is it going to need time to develop? And also, you know, whether it's out of the money, like, or how far out of the money, or is it at the money? So, you know, there's all these different inputs. That's what we call them, is like the inputs that go into really like determining what makes like a good setup. So yeah, this was a lot of information, right? But once you get the fundamentals of this strategy down, and you know, the work, and you work on the process of it, it's going to come to you a lot faster. And you know, that's why we're here. We want to remove some of the confusion, and you know, give you guys like the best setups that we screen for. And you know, if you don't really have your fundamentals in place, then you're actually in luck, because part of the surprise of today's webinar is that there's going to be education. There's going to be an education course coming up, ready for launch. That'll be included at the end of this. So you know, something that we've worked on, and you know, if you are lacking in that fundamental aspect of options, we will have that education material ready to go live at the end of this. It's a little sneak peek of the surprise. Hopefully I didn't ruin it. Mike might yell at me. All right, so let's get into some of the recent examples, because I'm sure that's what you guys want to see. So the switch is it's a recent earnings. So we're going to try to use examples that, you know, just happened in the last couple months. I mean, real recent. And switch is super recent. I mean, it was last week. And it's actually been a name we traded a few times this year. It popped on our radar again for earnings, and it had a really consistent pattern the previous 2 quarters. It would rally into earnings, stall right at a downtrend, and then get hit hard basically each time. So, you know, it had a pattern, and that's part of one of the inputs, right? You know, we wanted to see what it did like the last couple quarters. So it had a really obvious pattern. And the options, you know, so to kind of refer back to these inputs, it's, you know, like the options, we wanted to see what was pricing in, and the options were pricing in a 1.5 give or take point move. But we knew like the last quarters would move closer to 2.5. So again, you know, referring back to those inputs, you know, we knew what it did in the past, we knew what it moved in the past, and then when we compared it to what the options were pricing in, I mean, there seemed to be some potential there. So when we were looking at this trade, we thought a strangle was interesting. Options appeared underpriced, you know, based off what it had done recently. So we decided to enter the strangle into earnings, and the price paid was 85 cents, as you can see there. Now we're gonna fast forward, and you'll see, like, so the company turned in lousy results, missed or weak guidance for the 3rd straight quarter, and the stock got hammered. And really, it played out like super similar to what it had done the 2 quarters prior. And you know, those options that were priced in $1.50, you know, the stock ended up moving closer to 4 points, and we were able to sell the put side of that strangle for 280. So you know, overnight, you can see, I mean this is literally just, you know, get in one day and they can close it out the next day, and then, you know, you're basically got almost, you know, 250% return overnight. All right, yeah, 250%. I think my math's off. So like, you know, $1.95 per trade. So like the put will be worth a lot, and the call will be worth a little. That's just the nature of strangles. But you know, it's just one of those names that like fit that radar, right? That screening process of what we were looking for. And it had like those inputs. You know, referring back to those inputs, it hit like a majority of those inputs. So Dix is another one. You know, we'll start going through like the setups a little bit quicker. But Dix is it's a pretty volatile retailer, and you know, retailers for us are some of the best opportunities when it comes to earnings, just because they're really consistent movers. And Dix was an interesting trade setup for a few reasons. First off, we love when stocks are in tight setups. So you know, when they're not moving around, kind of consolidating, and then there's really key levels, you know, either above or below. So for Dix, for instance, had, you know, key resistance above and a major area of support below, and that creates what we call the combo trades, so the earnings combos, and that's really one of our favorite setups. It's the combination of earnings priced in move plus a technical move on top of that. So you get an earnings move plus a technical breakout or breakdown on top of that. And that's really, so when you get those 2-for-1 moves, that's really how you beat the street. That's what we say is the way to beat the street. It's like when you find the patterns that'll give you 2 for the price of 1. And that's what we called like the earnings combo moves. And Dix screened, it hit our screen in our radar as a potential earnings combo move because of like those really key technical levels and tight consolidation. So for this one, it was also, you know, there was sector strength, and you know the stock had been typically been a big mover. So when we entered a trade, it was a strangle again, and you can see that we paid $1.80 for the trade going into earnings. And you know, big pop, nice number, kind of caught up with other apparel names in the sector, which were performing really well. Dick's had a big catch-up move, and it had that combo move. So you can see it gapped up, and then once it cleared 33, 34 resistance, it had another move on top of that. So options that were pricing in about, you know, three-ish points ended up moving closer to 7 because you had that 2-for-1 type move. So when it popped, we were able to sell the call portion of the strangle for over $4, so for $4.20. So you know, buy for $1.80, sell basically the next day for $4.20. And you know, those are some of our favorite setups, and really what we're screening for when it comes to like these event style trades. So LL, another one. This one slightly different. You know, we wanted to give you 3 examples of setups that were a little bit different. LL was slightly different than Switch or just the recent Dix example. And this was really a great example of what we mean when we say understanding what the market is not pricing in. And it was actually a pretty strange setup overall, to be honest. It was coming off a bad quarter in May, which you can see like the stock got hit pretty hard. But then it had this huge run in June, and it was trading strong, and so it basically erased all the losses. But going into earnings just a couple weeks ago, it was really odd that it was up so much because a lot of peers, so Lumber Liquidators, for those who don't know, I mean, it's a housing supplier that does flooring, and you know, peers were getting rocked. Just Mohawk was one, and it just had like a really ugly number, and it you know, when the sector peers aren't acting great, and Lumber Liquidators is trading higher than where it was last quarter after it missed, it just seemed like there was a disconnect between what the market was doing and what the earnings could potentially be, right? So we thought that there was some kind of you know, inconsistency there. Like the options weren't pricing that big of a move. We already saw what it did last quarter after a miss. I mean, it got hit for about 3 to 4 points just off a miss last quarter, and so there was kind of like this playbook already out there for us to go off of. I mean, we knew if it missed, there was a chance it could drop to really quickly retest that May low, because it, you know, we saw that last quarter on a miss, it moved 3 to 4. So we figured, you know, taking a shot on some out of the money puts was worth the risk because of the potential reward. So as you can see, we paid 50 cents for those. These were short-term out of the money puts. And surprise, surprise, I mean, Lumber Liquidators missed. It was ugly miss. And I mean, Mohawk kind of tipped the hat, and then, you know, Lumber Liquidators followed along. I mean, it was really ugly quarter, and it gapped down and retested that May low perfectly. So, you know, those 50-cent puts turned into $3 the next day, and we were able to close those out for a really big gain. So San Nima, 4th one, and this is so San Nima is going to be one that doesn't work. And the reason we want to talk about it is because even when there's solid setups and the strategy fits most of our criteria, or it hits a bunch of those input bullet points, that doesn't necessarily mean it's going to work. And San Nima is an example of one just recently that just didn't pan out. We played this one on earnings in April, and you can see it had like a huge pop in April when it reported, and then it rolled over and it was in a really tight range. So it kind of crossed our radar because, you know, we had a trade on it in April that worked out, and, you know, tight consolidation, key levels, there was gaps above, gaps below. It had a history of big moves. So it basically hit like a bunch of our bullet points of what we were looking for. And for this one, we went with the strangle also. It had gap down 2 quarters ago, gap up. We weren't necessarily sure on the direction. We just thought that it was going to move, so we went with the strangle. $1.35 to get involved, to buy the strangle. And what happened? I mean, like, fast forward, and the number was mixed. So it wasn't a clean beat. It wasn't a clean miss. And when that happens, it kind of leads to some choppy action. As you can see, like the stock really didn't do anything. It didn't move far enough to break the 200-day resistance. Didn't drop far enough to break the 50-day support. So it didn't move enough. And like, this is the example of something where it may have been a perfect setup, but it just didn't work, and that happens. But when it comes to these setups, you want to find ones that cross off a bunch of the bullet points, and as long as the risk is within your parameters and well defined, then it makes sense to take the trade, because yes, some aren't going to work, but then you're going to have others like the lumber liquidators and the switches, which work great. But that's why it's like really important to be patient, find the good setups, and keep that risk profile. So like the risk that you're willing to put into these trades, you need to have like a plan where how you kind of keep it even across like the different setups. So at this point of the quarter, earnings season is winding down, but we like to say we're not slowing down. So there's always opportunities coming up. The calendar is like a never-ending supply of different events. So you have FDA and drug updates, like all sorts of different like pipeline updates for biotechs coming up, upgrades and downgrades, economic data releases. So jobs reports on the first of the month. Every month are typically, and have been recently, pretty big trading days. Government action, so Fed rate hikes, but you can also throw Trump's Twitter feed into that mix, right? Like, I guess that's kind of government action. I mean, that's a never-ending source of different news. M&A activity, of course. And honestly, like, that should start to pick up in the back half of this year. I mean, it's been kind of quiet, but I mean, I feel like normally you get a flurry in the beginning and a flurry at the end. So I would really expect that to start picking up again. And then industry and competitor news. So tariffs have been a hot topic this year. OPEC meetings, analyst conferences, and all sorts of stuff like that. So long story short, if you're not watching these events, and if you don't have them marked on your calendar, you really may be leaving a lot of money on the table. And honestly, like, this is why we focus on it so much, because it's just there's consistent news-driven moves in the market, and options just provide like a fantastic way to capitalize on those events. All right, so we just went through a bunch of earnings. Now we'll get into some other event-driven trades. So kind of like the areas outside of earnings. Nike is a favorite name of ours. I mean, we've traded. If you guys are subscribers to Letter, we've traded a bunch of times already. And Nike got a big boost last World Cup, so 2014. We knew going into this year that the World Cup was coming up, and we knew at the previous World Cup that Nike was one of the big beneficiaries. So coming into the year, we didn't do anything with it right away, but as we got closer to the summer and the start of the World Cup, it was definitely something that was on our radar. But we also, just because we wanted to get involved didn't mean we were just going to, jump in. We wanted to wait for a good setup. So as you can see in May, when it was stuck below 70 for a long time, and then it finally broke out through what had been kind of like pretty heavy overhead resistance, and that kind of was the point where it was like a nice technical breakout to line up well with what, for us, using past history, was a pretty strong seasonality trade. But the thing with this is that because of the nature of the trade, I mean, you want to be you want to get the time frame down straight, and that kind of goes to what Kurt was talking about earlier, in the sense that time frames really matter when it comes to options. And what we did was, like, looking back from the period from 2014, we saw that from June through September, Nike had rallied close to 25%. So we knew the potential was really, really big. So we didn't want to like cut ourselves short. So we wanted to make sure we had enough time. So we went with some longer dated call position for this. And that's why you can see it was a little bit more expensive. So like 260, but it's because we were paying for time, because we wanted to be able to ensure that we had the ability to ride it through the World Cup. So, I mean, starting in May, so obviously you need a few months. And actually, this actually played out like really fast, because the June quarter was super strong. I mean, you can see like the stock ran into those results, and then had a blowout move, and definitely a portion of that was due to the World Cup. The company cited on the release that Europe was seeing like strong football sales. So, you had a big quarter, and then like the future orders were good also because of the World Cup. And it really played into the whole seasonality thing. It's like you recognize the pattern, and then you can design the trade to capitalize on that pattern. So for this, we've had to pay for time, but the calls that cost 260, we were able to exit on the day of earnings for 750. So, just in a little over 2 months, I mean, almost a 200% return. It's pretty amazing. So another one, so the OPEC, right? Oil is super volatile when it comes to these OPEC meetings, and June had an OPEC meeting. It was the crude was up a bunch this year, so people were kind of focused on it to see, what the next move was going to be in the commodity. I mean, it influences a lot of stocks along with it, and we decided to play this event. We wanted to go with the XOP. So for those of you not familiar with it, the XOP is an ETF that focuses on the E&P names, so the exploration and production names. So this is typically a pretty good, it's pretty highly correlated to oil. Obviously, I mean, as producers, I mean, it's going to rise and fall. Like, the companies are going to benefit by higher oil, and likewise, like, they'll do poorly by lower oil. So XOP was, the way we wanted to play this meeting. Expectations were mixed going into this. Oil was up a lot the year. People were saying that, if they didn't have a material cut, then it could go down. So this was like one of those setups where we knew based off previous OPEC meetings. So going back, we saw that, in OPEC meetings, typically very volatile. And the aftermath, there could be like strong follow through in either direction. So we wanted to be involved, but the direction just wasn't clear to us. I mean, we didn't know if it was going to break higher or break lower. So a strangle made sense. We paid for a little extra time. So that's why you can see it was 260 to enter the strangle. But we knew based off recent past patterns that it was worth it, because these events had tended to create some huge moves in the energy space. So we went long the strangle at 260. And fast forward, oil took off higher almost immediately, and then the correlated E&P names, it took about a week extra to move higher. So oil put in a 52-week high, and then a week later, the XOP, you can see, put in a 52-week high. So we were able to flip the call side of the strangle for 370, right? So even paying up for the options, it made sense, because past history showed that paying the premium for these types of events tended to work out in our favor for options. So this is like just one example of why like different events can still create like great opportunities. And like Sanema with the earnings, Athena is an example of something that just didn't work out. And you know, sometimes these trades work perfectly, but other times, you know, they're just a bust. I mean, M&A stories like Athena are always really tempting because the prospect of a big premium. So somebody comes over the top and you get, you know, a huge payday on the options. But Athena was interesting to us because, I mean, a lot of times M&A stories come out of nowhere, but for Athena, there was already a 160 offer on the table. So I don't know if you guys are familiar with the story, but there was an offer on the table, and the company turned it down, and then the CEO stepped down. So basically, once the CEO stepped down, they said that they were open, they were exploring options, which means that they were potentially like fielding bids, right? So they already turned down 160. Analysts had come out and said that the company could be worth 170 to 180. Some said 200. We saw options piling up in the 165 to 170 range. So we knew that the M&A story was confirmed, which is half the battle when it comes to these. And then we already knew they turned down 160, so it made sense that it would have to probably be on top of that. So that's why like a call spread made sense, because we could go at options, above where it was trading, but also kind of lower our risk by selling like even further out of the money. So it was 170, 180 call spreads. And to us, it seemed like an interesting bet because, if the bidding process played out, the options were, decent priced for the potential reward if a higher bid came in. So we targeted a call spread. 280, 245 is what we paid. And then we sat and wait for any sort of development. But, continue to sit, continue to wait. And for Athena, with expiration last week, nothing materialized by the time the options expired. So the call spread expired worthless. And, for us, it was a good setup. The options gave us that defined risk. So, if the stock rolled over, at the time, we always knew what we were risking. I mean, like the risk was the price paid. 245 is what we paid. 245 is potential max loss. So it was worth it, and the potential was worth it. But in this instance, there just wasn't any sort of major development while the contracts were open, and it expired worthless. And that's why sometimes the setups can be great, but they just don't pan out. And that's why keeping like that risk profile even, or having a well-defined risk parameters really makes sense, because it'll help you manage all the trades you put on, and you won't have like outsized losses if you step out and really increase your risk into like certain trades. So so with that, we had a bunch of different examples here. So with that, I want to turn it back over to Mike. I think he's going to take it over from here.
Okay, guys. Can everyone out there hear me? Can you type a 1 in if you can hear me? Okay. So I'm going to talk about the options in play program, but very quickly, I want to know, what's your biggest challenging option? What's the thing that's bothering you most when it comes to options trading? Just type it in the box. Like, what's the one thing you could fix? I'm just curious. FOMO, fear of missing out. Theta decay versus the growth in premium. I'm a rookie at this, but eager to learn. Picking the right play. All right. Now, the good news is that these are all problems we can solve. We can solve them together. And frankly, we can solve them at a ridiculously low price. So I'm going to talk about, so we're going to start with the options. The whole program is about Kurt and Dan basically doing all the work. So we talked a lot about the potential for event-driven options trading, which most people are not doing because it can be a little bit overwhelming. But since Kurt and Dan are professionals, they're watching the market nonstop. So they can pick out the most attractive events out of the thousands of earnings reports and upgrades and central bank meetings, FDA news, all that stuff. They know how to pick out the right options contracts with the best risk reward. And they can give you the plan in plain English, which is very important because I think a lot of option stuff, it's very overwhelming. It's too math oriented, but they do a great job of delivering the plan in a way that anyone can understand. So this is just a very quick idea look at what the newsletter looks like. Everything is clear, simple instructions, plus you get opportunities the team has on the radar. There's intraday alerts, so whenever there's an update, you get it in minutes, so you get new opportunities as the team spots them. 2 to 3 per day, and again, 100% transparency and ease of use. Everything gets followed up on. If you know anything about newsletters, you know a lot of options newsletters use weird contracts that aren't easy to trade. Dan and Kurt only use liquid options that are actively traded. All the strategies are easy to implement. You don't need a lot of margin. So just a quick recap. We're including the newsletter with daily trade suggestions, 2 to 3 intraday updates, 100% transparency, easy to implement strategies, a huge discount, and one more thing. So we are adding starting today, a special new bonus valued at $395. So all you guys, the rookie that wants to learn, you want to understand theta, you want to understand growth in premium, you want to learn which contracts to pick, how to set up trades. We're going to show you how. Now, there's 3 big problems with all the option education programs you see out there. They're usually created by these professor types that have never even placed a trade. So they're focused on complex math, they're focused on equations instead of tactics you can actually use. I mean, they ignore things like getting orders filled at big prices, which is a huge part of options trading. So we're talking about generally there's a lack of real world on the ground trading. But we're changing that. We're introducing the actionable options program, and I think you can guess why we use the word actionable, because we want to give strategies people can actually use. So it's over 3 hours of video training. It includes 299-page user guide, full training at 14 different strategies, including 4 news-based strategies. So 4 special event-based option strategies, and everything is taught in plain English so that you guys, a lot of people are saying, I don't understand theta, I don't understand implied volatility. We explain it all in plain English in a way that's easy to understand, easy to grasp. So basically all those mistakes we talked about earlier, you can avoid them because you're going to have those strong fundamentals you need to succeed. So here's just a very quick screen grab of what things look like. And here's a good example. We talked about order entry. Like, these are the types of things you don't see in most options programs. Like just the ability to get in and out. You have to understand things like the bid-ask spread. It seems so basic, but most courses don't cover it at all. They just throw out random prices and assume you can get filled. Real life is not that easy. So again, this is an action-based program built for real trading by real traders, not by professors who can't make a dime. There is some math, but it's all easy to understand and it's all easy to implement. So just so you guys see everything you get today, 30 days of the Options in Play newsletter. It's daily trade ideas, 2 to 3 intraday updates, all easy to implement strategies, and the entire actionable options program video training over 3 hours. That's a $395 value. You can get it all for just $47.50. I am going to pop the link out to you guys again, t3live.com/options, and you can sign up. So just a few things people said. Melly was recommended on November 26th, made $1,000 per contract. Neil says many good profitable ideas of paid cost of subscription. Call trade and DXCM worked out very well for me, including the adjustment. We talked about adjustments before. A lot of people don't do them. We think you should. Chris from the UK, it's a great tool to get experience trading options, provide you with specific ideas. So again, frequently asked questions, because we get these questions a lot whenever we offer anything like this. Does the $47.50 price include the video course? Absolutely. It includes everything. Just $47.50, you get 30 days to take the whole course and the newsletter. And yes, you can take the course for $47.50 and cancel, but we don't think you will. What happens after the first month? Your membership renews at just $95. There is no obligation to stay on. After 30 days, you have 30 full days to take the course and test the newsletter. Again, just $47.50. A lot of people are asking already about margin and account sizes and stuff like that. So it's a good thing I have this slide. How much money do you need to trade these strategies? None of the strategies ever presented require a large amount of margin or taking extreme risks. You can, if you want, you can use one lot. And in some cases, that can only be a few $100s or even less. So you don't need a big account. We can't advise you on the size of account you need, but you can basically be as big or little as you want, whatever you're comfortable with. You don't need a lot of money to trade these strategies. So what types of strategies? Calls, puts, spreads, strangles, calendars, butterflies, all stuff that's easy to understand, and it's also all stuff that is taught in the course. So guys, again, just $47.50. Go to t3live.com/options and you can sign up. Another popular question is, do we short options? Short contracts are only ever suggested as part of a risk-defined spread. We do not believe naked shorting is appropriate for most traders. Are these trades risky? All options, as you guys know, we're all adults here. All options trading involves some level of risk, but the number one mission here is to select trades that balance risk and reward. We're not going to pretend there is no risk. There is always some risk in anything you trade, but Dan and Kurt do the work to make sure it's always balanced. So here's a good question, Sam. How do I cancel if I don't like it? All you have to do is call or email us, and it takes about 30 seconds. All you're gonna have to do is say, hey, this isn't for me, and we'll cancel you right away. We don't keep you on the phone for an hour. We make it really simple to cancel. Okay, so we are going to, okay, does this training go through the basics of understanding number of shares, stock per lot, and how to calculate amount per trade? Yes, all of the strategies include include the risk and the reward of the trade. Everything includes the risk and the reward over the trade. We can't tell you how many contracts you should trade, but we do go over risk and reward. The offer will be available. Cynthia is asking how long this offer will be available. It is available until Friday. Okay, so I'm going to bring Kurt and Dan on for Q&A.
Hey guys.
Okay, so here's an excellent question from Deborah. Would it be better? Is it enough to do just one trade a day? Is it necessary to take every single trade?
It really all depends on. I can jump on that. It really all depends on what you're comfortable with. If you want to do one, if there's one that looks good to you, then do one. If there's multiple trades that look good to you, then you can do multiple trades. It depends on what your risk is and really how active you want to be.
Okay, let's see. Okay, here's a good question. Okay, so do you guys, how do you guys feel about contrarian trading, which I guess would be going against whatever the popular trades are? Like, do you bet against the crowd?
Yeah, I mean, I'd say that we try to think outside the box. So if that means betting against the crowd, so it's not just what's a good way to describe it? So it's not just thinking just being like narrow tunnel vision on the FANG stocks. just being, bullish, nonstop bullish on the FANG stocks. Yeah, I mean, we're definitely looking outside the box, and if something is, if the whole crowd is like super bullish on Amazon, then we think there's potential for a bearish bet. Obviously that's something that would cross our radar, like definitely. We don't necessarily just do whatever everybody's doing. That's for sure.
Okay, so what types of strategies do you use most often?
We spreads, regular calls, puts, straddles, strangles. I mean, like those are our bread and butter. Definitely. Uh, we we'll do some flies, but yeah, I mean, when it comes to events, we love volatility plays. So straddles and strangles you'll see in the letter a lot, and a lot of spreads, just because it helps us manage our risk better when we have like the spreads.
Okay, so when you are issuing trade ideas, so do you include everything? Because a couple people are asking, like, do you include the strike, the time frame, all that stuff? I just want to make sure everybody's crystal clear on this.
Yeah. So it'll have the contracts, so like the type of trade, the contracts, and then it'll have it'll basically give like the trade thesis. So it won't say hold for a month or hold for 2 months, because the trades, different trades will have different reasons for being involved. But it'll tell you the rationale for getting in the trade, and it'll tell you the contracts, and it'll tell you the contracts, the trade style, and the rationale for being in the trade.
Okay, here's an interesting question from Brian. Brian, I'm gonna say you have the best question so far. So, how much does a trade alert actually affect the price of the options you're targeting? Which is, I guess, which is another way of saying, are you guys moving the market when you issue an idea?
I would say I don't believe so. No, I mean, I think we focus on liquid options, so uh, it shouldn't be a situation where you see like a ton of volume hit before you're able to like get in or out. I mean, we really try to focus on contracts that have good liquid intraday volume.
Yeah. I mean, so there's a few things. Like, I mean, before we talked about it, like Dan said, they always focus on liquid options, and so I do more behind the scenes work at T3, so I see more of the statistics behind the scenes. And the thing is, when people get alerts, not everybody takes action at the same exact time anyway. So there are some people who get alerts and they take immediate action. Some people wait like half a day, so it's not like a million people are buying the same exact contract at the same time. That just doesn't happen. It's more like very gradual, and it's not like people are trading like thousands and thousands of contracts. Okay, so so Mario's asking, do these strategies have the potential to provide a six-figure income, which is a pretty bold question.
Well, I think it comes down to what your risk tolerance is, right? So everybody's everybody's trade style and amount of money that they're comfortable having in the market is going to be different. So I mean, yes, I mean, like the potential is very high. I mean, we're targeting setups where we're trying to make 100, 200, 300% on the strategies that we get involved with. I mean, like that's we're targeting like those big percentage gains. So the potential is definitely there. You can't really I can't really comment on like the dollar amount, because everybody's the amount of money people risk is going to be different across different people. But I mean, in terms of percentages, I mean, we're always trying to target those trades where you can see like those, X percentage, 100%, 200%, 300% type returns.
Yeah, so I mean, some people trade one contract, some people trade 100. So in terms of like dollar amounts, that's really a lot of that depends on the way you trade and the size you're trading. So Sam is asking about how long do trades last?
Yeah, that's a good one. So what we do is we try to break out the trade. So we're going to have a little bit of kind of different time frames at any given time. So some trades, some event trades are literally overnight holds. So you put on one day and get out the next day. Some days, some trades are 2 to 3 day holds. So a little bit longer. And then we have some trades that are month or even some names have been up to like 6 to 7 or 8 months. It really all depends on the setup and really what the trade requires. So, but we do always at any given time have a pretty good mix of really short term, so like one day, some medium term, and then definitely some really like longer, so like month to even month to 6 month type time frames.
Yeah, so Mario is asking, are these strategies scalable?
Yeah, it really all comes down to so we like to say it comes down to your risk preference. So I mean, like the trades, that's why we focus on like liquid contracts, because you can get the size that you want on the contract. So in terms of scalability, I mean, I'm assuming you're talking about like it's starting at like 2 contracts or 20 contracts or 200 contracts, what have you. I mean, I think that's why we put such an emphasis on finding strategies and setups and stocks and contracts that are provide the liquidity needed to get the size that you want.
Yeah, so guys, again, I just want to recap the deal quickly. Remember, 30 days of trade ideas plus the entire video training program. It's over 3 hours of options training, and it covers everything, all the technical stuff like implied volatility, theta, and then on to 14 actionable strategies. It's over 3 hours of training. You can go to t3live.com/options to sign up. I'm also going to pop the link out to you one more time. This is limited time, and yes, it includes everything just for $47.50. So if you want to learn new strategies, this is the best way to do it because the price is just insane for a 3+ hour course plus a newsletter. So again, guys, go to t3live.com/options to sign up now. Okay, so let's see what other questions we have. Okay, so how hard are these strategies to learn?
These are really what we focus on are really kind of, I don't want to say basic. I mean, some are basic, but some are moderate trading strategies. So when you get into like the flies and maybe even you get some calendar spreads and flies. So like those are a little bit more complex, but really they're kind of like simple. Like they're not going to be once you understand how to implement them, they're not going to be difficult to do in the future. And actually, the options course tackles that pretty in depth. Like we go over a lot of like, well, basically every trading strategy that we do is in the options education course, and then we'll cover even like other things that we feel like that you need to know.
Okay, I'm just seeing what other questions. Do you make any market calls? So I guess people want to know, do you do anything with like bullish, bearish, straight up calls on stuff like SPY and IWM?
I mean, if the setup is worth it and the options dictate, we will consider just about anything. We also do use if it's worth it, then we'll look at it. But we also use the market timing. Also, we use options on the indices also as a way of hedging. So that that's a kind of like a different topic, but one that you'll encounter in the letter. You'll see that we talk about hedging. So if you got like a basket of positions, we'll talk about hedging with indices. But there's also certain instances where it actually seems like it's a good setup, and the options warrant taking bullish bets and stuff like that. So it basically what it comes down to, if it's a good setup and the options look attractive, then we'll definitely consider it.
Okay, guys, again, one more time. t3live.com/options. Everything is included. All right, so can we learn to fish from this course, or are the setups you call out only the best setups? Well, the newsletter setups are the trades they really like, and the course is for basically you learning to fish. So you take the course to learn your own setups, and you could take that with you forever, because the concept, all the concepts, all the strategies, they're still going to be valid years from now. So the course is basically you learning to fish forever. And then the newsletter on top of it is you get ideas from our team. So you win both ways with this package. That's the best way to put it. We throw you fish and we teach you to fish. So guys, again, you're getting over 3 hours of video training. It's a $395 course, plus 30 days of the newsletter, $95 value. Everything is easy to understand, easy to implement. We give you fish and we teach you to fish. Just $47.50. Go to t3live.com/options today. Sign up, limited time. Okay, what other questions do we have? Let's see. Okay, do you do anything with VXX or UVXY?
Yeah, so this is actually it's kind of funny. We were just talking about this, but the VIX, it very like unique circumstances when it comes to trading options, and there'll be times when we do trade it, but it's not a constant focus of ours. It can be. It can offer a ton of opportunity, but it can also offer a massive headache at the same time. And there's certain complexities to trading the VIX that can make it difficult sometimes. So that's why it's not a constant focus of ours, but there definitely are instances, and actually currently there's an open VIX trade, but there are times that we trade the VIX, like certainly. And I mean, sometimes it's worked fantastic, in February, for instance, maybe we were involved with it then. It was a great trade.
Okay, seeing what other questions we have here. Do you ever trade Apple options?
Yep, definitely. Actually, just had options on Apple into earnings just this most recent quarter. Yep.
Okay.
Definitely. No, there's really nothing. As long as the setup is good and the options are attractive, there's really no stock that we won't consider.
Okay, so what are the here's a good one. So what events are you looking out for? Like what's on the calendar that people need to know about?
Yeah, so retail earnings still ongoing, and in June, I mean, some of the best action, so the May to June stretch, some of the best action came from the retailers. So we're still kind of like knee deep in retail earnings. There's biotech events coming up in September. There get the industry conferences, so that'll start in September, October, and then, I mean, basically October So after Labor Day, you're gonna get earnings like firing up again. So there's really, like the next month, you're gonna get a bunch of retail, bios, some industry conferences, and then and really before you know it, the fourth quarter earnings are going to get going, and typically those are some of the most volatile of the year also. So really like the kind of pick up the pace like once the calendar flips over to September.
Okay, I'm gonna flip it out to the audience. So I want to ask the audience a question. So what is like the one thing? What is the one new thing you want to learn about options? Like if there was one new skill you can get in options, like what would that be? Like just type it in. Be honest. Okay, and want to understand implied volatility. So yes, the course includes a full discussion of implied volatility. I think it's the simplest and easiest to understand explanation of implied volatility. Um, Implied volatility is complex, but we focus on the main points, which are actually easy to understand. Implied, like once you understand the major concepts behind implied volatility, it's very easy to understand. It's all included in this course. So Diane's saying, I want to know how to make adjustments. So like, how does the course and options and play the newsletter help with that?
So adjustments in your trading style, adjustments in your trade management. I guess it's if you want to make it trade management, yeah. So we talk about that a lot actually. That's a great question, Diane. We really focus on trade management, and we talk about it in the letter. We talk about it in the videos. So if you guys want to like check out like the T3 Live Facebook page, we do videos, kind of talking about options, trades, like different things that are interesting to us at the time. So we talk about trade management a lot, and there's actually a section in it in the education course too. But we really can't stress enough how important trade management and what we call rolling. So we really can't stress enough how important it is, and we spend a lot of time talking about it. Rolling up, rolling down, how to manage winners, how to kind of like keep that risk in line. We really do spend a lot of time on it, and we talk about it frequently. And then our intraday alerts, you'll see us mention it very often as well. So that's a great question. I'm glad you brought it up, because like I really want to stress like how often we talk about trade management. It's a really big, I mean, just for any trader and an options trader, it's important, but we also like to highlight just how important it is, just because it really matters a lot. And I think that's what makes us different than other options letters, is that we actually like follow up after the trade, and we talk about the whole aspect of the trade, from getting in to getting out, why roll, why rolling makes sense, like where, like what contracts, like when to roll, what time frames, and stuff like that.
Okay, so Mario has a pretty staggering request. He wants to learn how to scan for the ideal Greeks when I want to go long on a bull flag breakout and only hold for about 1 to 3 days without theta killing my premium. Is Mario a little too specific here?
Yeah, I mean, I think we could probably have an hour-long conversation about that. So I mean, we could literally sit here and talk about that for a while. But I mean, if whatever platform you guys use, well, first off, I mean, I think it makes sense to find a platform that A, you're comfortable with, but also B, offers you the tools that you need. So if your platform's too basic, there's plenty of like good, like more intermediate platforms. And then for Mario, I mean, they're going to have different scanners or screeners available for you. So you'll be able to enter like the inputs that you want, and you know, depending on like the level of the screener, it'll be able to like pull up different names for you. But I mean, just specifically for like a trading style, yeah, I feel like we could spend all afternoon here like talking about that, and you know how and when and why and what to do with like those setups.
Okay, guys, so I am going to. Okay, so do you have researchers helping you find trades? That's a lot of work for two people, says Brian. So is it just you guys finding these trades?
Yeah, it's Kurt and myself. Yep.
Yeah, like you have to remember, Brian, with like full-time market people, they're not spending 10 or 15 minutes here and there doing things. Like they're spending all day looking at the market, and then basically the best of the best information gets funneled to you. So guys, we're going to close down very soon. So I just want to recap everything you're going to get. Again, go to t3live.com/options. I'm just going to breeze through everything. Newsletter with daily trade ideas. So you get new trade ideas you can put to work every single day. 2 to 3 intraday alerts. So when there is something to do, you're going to know right away. Again, follow up on everything, liquid options that are actively traded. Every strategy is easy to implement, and you don't need a lot of capital. You don't need margin for these trades. And again, you're getting the new actionable options program. It's over 3 hours of video training valued at $395. Full training and 14 actionable strategies. And what I think is the best guide to options fundamentals like pricing, market mechanics, order entry, all that stuff, so you can avoid all the mistakes we talked about before. Again, action-based program built for real trading by real traders. This is not a course built by professors who can't make a dime. And again, I'm just going to recap it one more time. 30 days of the newsletter to $95 value, plus the entire actionable options video training program. It's valued at $395. You get it for just $47.50. I'm going to make one last call for questions. Any more questions? Anyone? Going once? Going twice? And all right, that is going to close this out. Again, guys, one last time, go to t3live.com/options. You get the course, you get the newsletter, you save 50%. It's everything you need. We talked about fishing before. We give you fish with the ideas, and we teach you to fish. Over 3 hours of training, everything's included for $47.50. t3live.com/options. Okay, everyone, have a good night. And Kurt and Dan, thank you a lot for joining us tonight.
Thanks, guys.
Thank you. Appreciate you guys coming out.